All right, so we're gonna jump right in here to module 3. For a quick overview, I'll just go ahead and let you read over that. But this is focusing on how we get the value of a stock, right? Um, and so we'll talk about fundamental analysis. We talked about technical analysis previously. Fundamental analysis looks at the particular firm. And then we're also going to talk a little bit about duration, which is our measure of sensitivity to interest rates with our bonds. So bonds and stocks. So as bond prices, or as I should say, as interest rates go up, bond yields will go up. And as yields go up, the bond price will fall. Right. This is just a relationship that if you've ever played on a seesaw or teeter-totter, as one side goes up, the other comes down. And that's precisely what we have happening in this case. As far as an increase in the yield to maturity is a smaller price change than a decrease, right? So we talked about this before, that line is curved. It's not a straight line. And so, we'll see differences depending on the direction. And then long-term bonds are more sensitive than short-term bonds. That should make sense because it's further out into the future. And so small changes in interest rates can have these compounded effects. Interest rate risk is less than proportional to the bond maturity. So we'll look at some examples of that. The interest rate risk is inversely related to the bond's coupon rate, right? So if the coupon rate were to be higher, then the interest rate risk would be lower. And if you think about that, that's because you're getting money paid to you over time, right? And so the more those payments are, then the less sensitive you are to interest rates. So to give a sense what this looks like, here we have some different bonds. You notice A and B have the same high coupon and C and D have a low coupon. The difference in A and B is this maturity time, right? Between B and C is the coupon rate because those have the same duration, the same yield to maturity, but you can see these impacts are different. And then the difference between C and D is that yield to maturity, right? So as you can see, all of these, you see the relationship as you're changing those. So as I said, we measure this sensitivity to change. It's something we call duration, and I'll show you the formula for that. But what we're trying to do is calculate what is the weighted average of the money that we receive, right? And so again, if you were to think about it almost like a teeter-totter, right? I can have like little bags of money to represent my coupon payment, and then I have a really big bag of money to represent the final payment that at maturity where I receive par. And then the duration is basically where do I need to put my balance point for these things to balance each other out. Okay. So if it was no coupons, there's no bags except for the one big bag at the end, then obviously where it sits is the balance point. Right. And so the duration is equal to maturity for zero coupon bonds. But otherwise, because we're receiving this money before we get to the end, the balance point is going to be closer to us. And so that's what we're looking at. So the formula itself looks like this, right? Where the weight that we have is just this proportionality of these cash flows through all these various periods of time. And then we are going to weight, that's the weight that we have. And then we just go for every time period. Okay. And so this right here would give us duration in the event that our periodic cash flows are equal to 0. Then this all ends up being at maturity. Okay. This right here is the price change that we are going to receive, right? Which is this duration that we have, right, times the change in how this interest rate, right? Because if we look at the Y before, that was our yield to maturity, right? So as that yield changes, right, multiplied by duration, that tells us what the price change will be. And then we also have something that we call our modified duration, which instead of this change in 1 plus y, it's using this delta y, but we have to change the way we calculate this to account for that small difference. Okay, so here's some rules around duration, right? So it's a couple of different slides we're gonna look at. Okay, so that just tells you that this relationship with duration, and the duration of a level perpetuity would just be equal to this relationship here. So sort of like when we had a perpetuity and it was C divided by R, right? This is 1 plus Y divided by Y. And that would be our duration. And so this is an example of bond duration versus maturity. So for a zero coupon bond, obviously they're going to be equal. But you see these other coupon bonds and how they look differently. To that, this lowest coupon obviously stays closest to it the longest, right? The larger coupon bonds, they diverge quicker, but the difference in the coupon and the yield to maturity, right, helps, because the higher the coupon relative to that yield to maturity, the straighter that line will become. So when I'm talking about like the straightness or the curvature of the line, the mathematical term for this would be convexity, right? And so when we're looking at this, we talk about these duration changes, and it has to do with how sharp that bend is, how curved this bond payout is. And so the higher convexity, the higher the curvature, and that means it's going to be more sensitive to those changes. Right. So here's an example. Duration is really good for this short-term change, but if the change is larger, we would want to actually keep calculating what those durations were for it to follow that line. But we normally experience interest rate changes that are relatively small. If you listen to when the Fed recently raised the interest rate 75 basis points, that's 0.75%. Less than 1%, it was sufficient to get people a little antsy about that being a big change. So normally these changes are going to be very small, but they can be frequent, and we just need to make sure we are updating. In fact, this is what bond fund managers are doing. They're checking these out. Here's the calculation for convexity. Just understand that would be convexity at that particular point, right? And as we saw, they can change, right? And so we could take what we initially had for our modified duration, and then for our change in the rate, and then we can also have this convexity for this square term, right? And by adding that, it gives us that the duration rule, right? And so this is the duration, then modifying it for convexity, right? And then this is to show you how that's convexity would be different. So we would want to be able to pick between them, right? So the more volatile your interest rates, the more convexity is appealing to you. But you are entering into something that's a bit riskier if it were to go the other direction. But yeah, so just to keep that in mind, we're actually trying to fit the duration of our debt that we're looking at normally with our assets, and so we're very sensitive to things like the duration and convexity. If the bond is callable, right, then we understand that there exists certain yields where this would just get called, right, and that kind of thing. So that lets us know what this is going to look like. And so if we were to graph that, you end up with this change in convexity, right, where it's negatively convex, right, and then positively convex. And you may have learned about had this called concave and convex. There's very specific mathematical terms for that. But yeah, so the negative convexity. Like I said, you may have heard that as concavity, but to be strictly speaking, we would say negatively convex within finance. And then mortgage-backed securities. This is when you have a number of mortgages, right? And so basically it's just a collection of loans. And so we have this negative convexity because homeowners can always go and repay the loan, right? And often they will refinance the loan if interest rates move in their favor. And so when we're looking at things like mortgage-backed securities, they get a bit more complicated. And then this is for that initial, what we call mortgage-backed security. You can also turn that into some sort of a collateralized mortgage obligation, right? So you could change the structure of it. When we do that, we normally split these up into what's called tranches. And so a tranche is just French for trench. So yeah, you can think of this as a series of trenches or ditches that you're just dumping this water into as it comes in. You put it into the top ones first. Normally there's some agreement that a certain percentage will go to all of them, but there's definitely a priority where we allocate more money towards the top tranches, and then once those are full, we go to lower ones. And this would allow this to have a AAA tranche, a triple B tranche, and then, you know, the speculative type of tranche. So they're able to build what is most appropriate for your investor, right? That was the idea, at least when we started doing this a lot in the early 2000s. So yeah, that's mortgage-backed security. So let's talk about passive bond management. So when you're being passive, obviously the difference between passive and active management is you know, how you're going about doing this. The passive managers normally are trying to just take markets as giving them what the price should be. And then they either try to build a bond index, and I'll go into some information there, or they try to immunize the bonds themselves to give you that return, but with less risk. So with a bond index fund, basically you try to buy very many bonds, right? And then you use those bonds to create your portfolio. Okay, but bonds are while things like treasuries are very actively traded, not all bonds are, right? And many bonds are actually thinly traded. Once people buy the bond, the idea is that they're going to hold it, which makes rebalancing your portfolio a challenge. So often what they do is they come up with what they call a cellular approach, where you stratify your bonds into cells. So this would be an example of that, showing how much they're putting into, you know, various types of bonds over various maturities, and then building the portfolio that way. Second thing you can do is immunization, where what you're trying to do is just minimize the risk exposure you have from interest rates, even though you're holding all of these bonds. And so the duration matching your assets and your liabilities. In the case of this, let's say a pension fund, their assets are going to be all these bonds that they buy, and their liabilities are the pension payments that they have to make to the retirees. Right. And so they know on average our retirees will live this long, so they're going to receive these payments for this long of a duration, right? And we're talking about averages, but then we can balance our portfolio to have a similar profile, and therefore they will balance with each other, right? And so this is what immunization looks like. You know, we're basically trying to make it as close to tangent as possible. If you see here, you know, with our current interest rates, we match up, but we're trying to build the portfolio so even if it moves, they move together. Okay. Another thing is like this cash flow matching. And so this is obviously where you're trying to have bonds paying you at appropriate time. for you to then pay cash out as needed to cover your obligations. It's a challenge because, again, you can't always find a bond that matches exactly what you need. That bond does not necessarily exist even. But by doing that, it eliminates a lot of the risk that you would have worrying about reinvesting and things like that. So sometimes you can't do it, but when you can, it can really help with balancing things like pension funds. So here's some things. I'll just let you read over this. But when you're actively managing bonds, these are the kind of things that you can be looking for. You're going to be actively in the market trying to find some sort of mispricing that you can take advantage of. Horizon analysis. We talked about maturity, right, and how long that is. We talked about the duration, which is this measure of sensitivity. The horizon is basically what's the period that I no longer worry, right? And so if I'm a pension fund, if my retirees tend to retire, say, age 65 from my industrial plant, and most of them will pass away at, say, age 80, then I'm really focused on that next 15 years. And so I may not be as worried about, say, a 30-year yield. And so you just understand that every fund will have their own horizons, right? Just like every investor as an individual has their own horizon. So this is just another one of those pieces that they look at. Okay. And then here's just some bits. I have 2 slides here on the global economy. Just understand that as an investment banker, you're looking at the sale of securities in the what we call the primary market, right? When we're bringing things to the market initially. And so as we're going through the global economy, these are the kinds of things that we're focused on, taking those things into mind, right? And before you took this, I mean, way back early on, you probably took micro and macro economics. And so this macroeconomic environment that we're in, these are going to be some issues that we're looking at, things like GDP, unemployment. There's also like workforce participation rates that we'd also look at, inflation, interest rates. These are things that would be indicators for, is the economy going to be growing, like an expanding economy or a shrinking economy. One of the things that's not listed on here that is becoming more and more of an issue is demographics, right? As workforces age around the world, the impact that has on both consumption and savings. These are some examples of supply and demand shocks. So, there's changes can happen, which will change the demand for your products, right? And these are not things that you did, but these could be changes in the larger economy, right? And then supply is changes to production. Here's some examples of government policy. So a lot of policy that we've had initially was on what we call demand side, right? Where the government would step in. This is like the Keynesian or neo-Keynesian, you'll hear, where the idea was if the government, if there's not enough demand for these materials, the government should build things like the interstate system, right? Because that would employ a lot of workers. And since we're spending all that money, those workers would then go out and spend it, right? And so that is what we use basically from the Great Depression in the 1930s all the way up until the 1970s and the oil crises. And so since the 1980s, the focus has been what they call supply side economics. So this is monetary theory. And so the idea is to focus on creating environments for people to go create new things, right? And so we're trying to spur the supply, not so much create demand by government spending. So that's, like I said, that's monetary. So fiscal is how the government itself is going to spend money, and because the government can decide, where to spend the money, right? And so we'll talk about budget deficits and things like that. This class doesn't really get too much into, how good or bad those are. Just understand that, as this money is being spent, there's going to be an economic impact. And then as taxes are paid, there's also an economic impact. Okay. The monetary policy, like I said, this is more impacting how much money is out there, right? And so we normally talk about money supply as M2, but there's all these other measures. There's M1, M3, but M2 is normally the money we're most focused on. And this is more setting the table. Again, this is like the idea is I'm controlling how much money is out there, and so people are going to get involved, right? And so what the government does to put money in and out of the system is they're repurchasing existing federal debt, or they're bringing more debt out onto the market, because every time they bring dollars out, they're bringing more of these securities back in, right? Or they're putting the securities out there, the banks are paying them with cash, and that money's coming out of the environment. So they're able to control how much money is out there through those policies. Right. Again, on supply side, the difference is not let's have the government spend money, more let's have the government create incentives, and then lots of different small companies will start on their own. No doubt you've heard about the business cycle and how we have booms and busts, or expansion and contraction. Within this course, we're going to be talking about the business cycle more just sort of generally. We're not trying to plan exactly when to enter or exit particular markets or anything like that. It's just more to understand the general ebb and flow of the economy. And then understand that some industries are very well correlated with the market, and some industries are not at all coordinated very well with the market, right? And so if you think about agribusiness, right, people need to eat no matter what, right? Good times and bad times, people still need to eat, right? But buying new refrigerators and new washing machines and new automobiles, those are things that are very sensitive to how the general economy is doing. All right. And so just as we talk about the larger economy, we can break that into smaller groups, such as an industry, and talk about, say, the steel industry or the automobile industry or telecommunications. And so we have these that we can look at very particular groups. Within the North American system, the NAICS are codes that will give you the same industry. Right. And so we can use the 3-digit, which is a bit more broad, and that's a sector, or we can go within the industry with the 4-digit. And then we actually have some further classifications we can use to get a little more detailed. But this is to allow us to break the economy into like some very clear groups so we can see, because when we talk about leading and lagging indicators, those are often concentrated in particular industries. Okay, so as far as the sensitivity to the business cycle, right, there's 3 things to it. One is, how does it change your sales, right? Another thing is how that impacts based on your operating leverage, right? And then the last thing is our financial leverage. So as far as sensitivity to sales, this kind of gets back into, people are always buying food, but they're not always buying steak, right? And so some items are very sensitive, and then some are not at all sensitive. And so that's the first thing we need to look at. Then the other things, obviously the operating leverage, right? So are we very capital intensive, right? And we don't have very many workers, right? Or is this something that's very labor intensive, right? Where I can bring in people and release people, but there's not a whole lot of equipment necessary. And that's what we're talking about is there. So if you have a lot of fixed costs, you want to run those machines all the time, right? Because you've already paid for it, and you just want those to run. But if you have very low fixed costs, very high variable costs, you can always fire workers or hire more workers, right? And so you can change what you're doing based on the business cycle, right? Because you don't have to pay for labor you're not using. You can just let them go. But with the machine, you bought the machine. You can't just fire the machine and stop paying for it. That's not how that works. So, but yeah, and then the financial leverage is basically how much of it is like fixed, like interest, right? Those types of things versus stock, because the bondholders get their guaranteed return and stockholders want high returns, right? And so that mix will affect us. And so this is just an example of going, we expand up until we reach some sort of peak, and then we'll have a contraction until we reach some sort of trough, and then we'll expand to a peak, and this ebbs and flows. And this, as we wrap up, just sort of talk about some other things you can do. So here's an example with the sector rotation. Also industry life cycles, trying to plan when you're going to go in and out of an industry. These phases of an industry, I have a chart to show you that. So basically with startups, we expect to see very rapid growth that normally happens in that period. And then once they start to, they grow into a pretty good size, they're starting to get nice contracts, or they're doing all of those things. And that's where this stable growth period is in. And then as the industry starts to mature, people understand how this works, all the big players are in there, then it starts to slow down. And then we finally reach that mature industry, which are things like sodas, right? Not to say that new sodas will never enter the market or anything like that, but this is most of the soda now is owned by a few companies, and they introduce new things just to create sort of new little niche markets. But it's a very mature industry, right? And so we're not expecting to have new breakthrough companies. All right. And so here's like what we would consider the 5 determinants of competition. How competitive is this industry? A lot of it has to do with the power, both the buyers and the suppliers. Are new people coming in, or are there barriers to new entry? Is there a lot of rivalry between the existing competitors, or is this more of a friendly understanding? And then are there substitutes that we're needing to worry about? So that is all for chapter 3 or module 3. And then I will have module 4 that follows this one up.